Welcome to Earshot, and this is Girl Math.
Hi there. You must often hear about IPOs or initial public offerings, or about a company going public. Often, a sought-after IPO, there's a mad rush for owning shares of the company. What exactly does that mean, and what does the IPO process entail? By the end of this episode, you will be much more informed about this topic.
As always, you are listening to Girl Math, a podcast where we help you figure out finances right from the basics to the big things. We sincerely hope to be the sane voice that cuts through the noise and acts as the starting point on your money management journey. I'm Dipavli, and with me is my co-host, Garima.
So what is an IPO? Let's dive right in. You must understand what a company is, right? By definition, it's a legal entity formed by one or more individuals to engage in business. A company is usually privately owned by founders, early-stage investors, or venture capitalists. By going public, the company has access to more public funds from diverse sources. They can raise substantial amounts of money that might not be available through private financing alone. Once a company goes public, it transforms from being owned by a relatively small group of people that are founders, early investors, employees, etc., to being owned by thousands or even millions of shareholders. For a company that is public, its quarterly reports are open for scrutiny and it is subjected to greater regulatory oversight. All this rigor can build investor confidence in the company. So an IPO does not only enable a company to access public funds, but also to increase its brand visibility, valuation, and reputation. Besides that, an IPO gives an exit route for initial investors, so they can encash profits by partially or fully exiting their investments.
With that, we come to the IPO process itself. The behind-the-scenes work that no one sees, the part which involves intense regulatory compliance, due diligence, and marketing to make the company appealing to investors. First, the company needs approval to go public by its board of directors. After that, the company appoints merchant bankers and underwriters to set the IPO process in motion. Merchant bankers are like the project managers of the entire IPO process. They help with compliance, documentation, pricing, and marketing strategies. Underwriters are financial institutions that take on the risk of unsold shares. They buy those shares. Now, why would they do that? When an IPO is undersubscribed, which means fewer shares are bought than those offered, then the underwriter picks those up because it has already done its due diligence about the company and is convinced about its financial health and long-term prospects.
So what follows this step is a complete health checkup of the company. Its financials, operations, legal standing, and management credentials are scrutinized. The company's disclosures are verified. All of this ensures that the company is market ready and has no red flags that could delay the filing or create any other roadblock. Next, the company prepares what's called a draft red herring prospectus, which is submitted to the Securities and Exchange Board of India, SEBI, the market regulator. This consists all the information about the company, including its businesses, financial statements, its risk, promoters, and what it intends to do with the funds. This serves as a reference for investors as well. Some companies opt for the confidential route of DRHP filing, in which case the company's financials and other sensitive information is not immediately available to the public, but is accessible to SEBI for review. The confidential route allows the company to address the feedback from the regulator and also assess market conditions, refine the IPO blueprint, and modify the IPO timing and pricing strategy.
Now, once SEBI grants approval, the IPO can open for subscription. SEBI review and approval can take 4 to 8 weeks, during which SEBI may ask for clarifications. Then comes the marketing part, where merchant bankers meet potential investors to generate interest in the IPO. These investors can be institutional investors, merchant bankers, and high net worth individuals. These meetings are called roadshows. The objective is to convince investors about the company's growth story, competitive advantage, and its prospects.
Now, one of the most important steps in an IPO is setting the price of the share. This is called the book building process and is executed in the way I shall describe. The company, along with the underwriters, sets a price band specifying the minimum and maximum bid prices. The underwriter, along with the issuer, then invites investors to submit bids for the shares being sold through the IPO based on the given price range. The underwriter keeps a book that records all investor bids, and then a weightage average method is used to determine the IPO price. Investors whose bids meet or exceed the cutoff price are allotted shares. Those whose bids exceed the cutoff receive a refund for the access amount.
If the IPO is oversubscribed, that is, if demand is greater than supply, then allotment is done proportionally or by lottery, especially for retail investors. Application money for unsuccessful bids are refunded. Allotment of shares is done within 1 day of issue. After allotment, the shares are credited to the investor's demat accounts. Now, one legally owns these shares and the investor has the option to hold them or sell them when they see an opportunity. The demat account simply stores the shares, but its value can rise or fall according to its market performance. Market price can change every day depending on factors like company performance, industry trends, economic conditions, investor sentiment, news, and global events.
Now, you might wonder how the cutoff price of a particular issue is decided. Pricing is arguably the single most important decision in an IPO, as it determines how much capital a company raises, how appealing its shares appear to investors, and how the stock performs after listing. The price is arrived at after considering the demand at various price levels during the bidding period, the price at which underwriters are willing to underwrite the issue, the current market conditions and investor risk appetite, and precedent public issues by similar sector companies.
Finally, what does all this mean to you? Should you invest in an IPO? There's no clear yes or no answer to this. One thing is for sure, that you do not buy shares simply because the IPO is oversubscribed. There's often much enthusiasm around the listing of companies, but that does not mean that their stock will necessarily perform well. Invest in an IPO only if you thoroughly understand the business or the sector. Ask yourself if its valuation is comparable to other companies in the same sector. You should remember that freshly listed stocks undergo price volatility, and also that IPOs are aggressively priced so that the company can maximize its gains. Buying at IPO is not the only way to own shares of a company. You can also wait after the company is listed and buy its shares on the stock exchange through a brokerage account.
Now let's have a quick overview of the kind of investors who invest in an IPO. There are of course retail individual investors, RII, which includes resident Indian individuals, non-resident Indians, and Hindu undivided families. The maximum amount of investment is Rs 2 lakh. If an investor qualifies to bid under the category but wishes to invest more than Rs 2 lakhs, then he falls under the non-institutional investor NII category. This category includes resident Indian individuals, non-resident Indians NRIs, Hindu undivided families, that is HUFs, corporate bodies, companies, trusts, science institutions and societies. The next category is of the qualified institutional bidder QIB, which includes mutual funds, public financial institutions, foreign portfolio investors, and commercial banks, etc. And finally, if a QIB makes an application of more than Rs 10 crore, then they are categorized as anchor investors.
Now, if you've been a committed listener to our show, we hope you have already started on your savings journey. The no-brainer route is to begin a mutual fund SIP. If you have already done that, you might be wondering what should be the next step on your investment path. It's certainly not jumping straight to investing in an IPO. You are building strong financial security just by starting the SIP and investing consistently. Next, you build an emergency fund and buy insurance like we've already told you. After that, whenever you are able to, increase the SIP annually and avoid unnecessary changes. Gradually, you can learn stock analysis and asset allocation. And finally, add direct stocks or other asset classes only if they fit your goals. A good way to become more knowledgeable about businesses is to read annual reports of companies, draft prospectus of firms going public, and of course, newspaper reports. Build this base because even financial knowledge is the starting point of being money wise.
We hope this covers everything you wanted to know about IPOs. See you on another episode of Girl Math, where we will unravel another finance-related topic that can make money management more accessible and perhaps even fun. Until then, goodbye and take care.
This was Girl Math, your formula to becoming financially fearless.